So a rental property, it gets set up for whatever you purchase the house for and whatever improvements that you make again. For when a house is in, now you've got a business, basically. You're renting your house. That's a business. You get to depreciate the property. So that is, the IRS says that for a rental real estate, you get to depreciate that over 27 and a half years. So every year you're taking a little bit of a deduction. It's not cash out of your pocket, but it's the deduction. So it lowers the basis of your property. When you eventually go to sell that property, you will have a gain, and that will be taxed to you. Any depreciation that you take on that property is taxed at one rate. It's called a recapture rate. It's 25% for federal taxes. And then any gain you have on top of that is taxed at capital gains tax rates for federal tax.
Wow. Okay. So essentially, it's a little bit different when selling an investment property. So essentially, they take into consideration the depreciation, and that's taxed at a certain rate, and then the actual gains is taxed at a different rate. Now, is the gains calculated the same way as a primary residence, meaning that what did you purchase at, what improvements did you make, and what are you selling it at minus any fees?
Correct, except the one additional aspect you have for a rental property is depreciation. So what you purchased it at, say it's $300,000, that's going to get reduced over time through depreciation. And so when you go to sell it, your basis might be $250,000 because while you've held this property as a rental, you've been able to deduct depreciation expenses over the years.
Nice. Now, let me ask you this, because like I have clients that are like older clients or like 80 or 90. Unfortunately, I mean, their health isn't that great. They're considering selling an investment property. Or the other option would be to just keep it until unfortunately they pass away and then allow the kids to sell it. What do you think would be better in that situation? Or what would be some of the things that people should take into consideration when selling an investment property in that situation?
Yeah, so for older people, it is a big decision at that point in time because odds are you've held the property for a long time. It's probably appreciated in value. So you could be looking at a substantial gain. If you were to sell it, you would have to pay taxes on all that gain. You would have less money to pass on to your heirs. If, however, you held onto the property until somebody passed away, that's an unfortunate circumstance, obviously, but the way it works with the tax code is when somebody passes away, the value at the date of death gets stepped up to whatever the fair market value is. And so say you bought a house for $100,000 50 years ago, and you're living in it, and now it's worth $1 million when you pass away. If you pass that house on to your children after you pass away, they inherit that house for $1 million. So they could turn around the next day, sell it for $1 million and pay no gains or no taxes on the gains because there is no gain. Their basis is $1 million, they sold it for $1 million. So it equals each other. If you were to sell that yourself while you're alive, well, I've got a sales price of $1 million, my basis is $100,000. I'm going to be paying tax on $900,000 of gain there. And so let's just say it's a third off the top of our heads, just for quick calculations. There's $300,000 gone. I'm only able to pass on $700,000 rather than letting my heirs sell the house and get a full $1 million for it.